PSG Asset Management runs a globally integrated investment process. That means that we don't only consider local assets against their local peers, but we consider them more broadly against the globally available opportunity set. And we always start with cash as the point of departure. Joining me today to explain our investment process in more detail is Chief Investment Officer John Gilchrist. John, so I think many South African investors think that the best opportunities are found offshore. Yet PSG Asset Management takes a very different view. Can you explain to us how you view the opportunity set?
Certainly, Audrey. I think what's probably best is to go back to our philosophy, the basis on which we make decisions and how we find investments. And we generally like to look in uncrowded areas, areas that are out of favor and unloved. And often those out of favor, unloved areas are also where we find very, very cheap assets. But being unloved, being out of favor, being cheap is not in itself sufficient. What we then try to do is within those uncrowded areas, those cheap areas, we try to look for elements of inherent quality that the rest of the market has missed. And we often identify these opportunities through taking a longer term view, looking beyond the current narrative, looking beyond the next year or two, looking for something that will ultimately come through and around which we can base an investment theory and an investment thesis. South Africa is clearly an area that is uncrowded, unloved, out of favor. One just needs to have a look at, for example, the most recent Bank of America fund manager survey, where it looks at global fund managers and looks at what areas, either geographically or in terms of sectors, global managers are most overweight and underweight. And within there, you will clearly see emerging markets out of favor, commodities, material sectors out of favor. So South Africa sits right at the crosshairs of that. We know foreigners have disinvested. We've seen the flows. In addition, with the change in Regulation 28 over the last couple of years, lots of local investors have also taken their opportunity to take money offshore. And as a result, the positioning is very negative towards South Africa. This is clearly something where we would prick up our ears. We would look at this as an uncrowded, out of favor area that's very cheap. What's absolutely key, though, and Justin pointed it out in a recent video, is that when you have these incredibly negative situations and the positioning is very negative, just something that is slightly less bad than what has been anticipated by the market can result in a significant re-rating and significant returns from those areas.
So John, can you give us some practical examples of where you've looked at South African companies in these tough local conditions that we've seen, and yet you see these companies as performing well, even in considering the global opportunity set?
Yeah, so I think one of the things people time and time again conflate and mix up is economic prospects and investment prospects. People assume that you have to have a strong economy to find really good investment opportunities, and that's not always the case. But that people always miss is you've got to consider the price that you pay for an investment. And so what we see in a number of South African opportunities that we're looking at is that the prices are low and they're assuming very, very poor growth for the foreseeable future. Often zero growth or just marginally positive is what is priced in. Now, if we look forward towards the end of this year, we're likely to see a resolution, at least to a certain extent, around the load shedding. And that's not anything that the government has done. That's purely in terms of the private sector stepping up, companies and individuals taking on provision of electricity themselves. In addition, there's a very high likelihood that we're going to see some cuts in interest rates. And so just those two aspects alone could create a little bit of a tailwind in terms of growth, ultimately coming through and challenging those very negative assumptions that have been built into those South African shares. What we've also seen with a number of our investee companies is that despite very, very tough economic conditions in South Africa, very strong management teams combined with very strong moats have led to these businesses actually being able to gain market share. So even though the overall economy has not been growing, their revenues have been growing. Because of those market share gains, they've been able to control their costs And so even in a very tough economic situation, they've been able to generate strong profit growth. Now, that's all well and good, but when you have a look from a global perspective, we believe the bar needs to be a little bit higher. Anybody investing globally has a huge number of opportunities in terms of where they invest their money. And as a result, we need to really weigh up the risk and return. And when you look at South Africa from a global perspective, the government clearly has not delivered. There's been a lot of talk, very little delivery, and the SOEs remain a complete mess. And so when we look at South Africa from a global perspective, the bar becomes higher. And of course, we also have the general elections coming up later this year. So we look at shares that are very cheap in South Africa, in this uncrowded, unfavored area. But also we look for opportunities from a global perspective where those shares have significant amount of earnings, either in dollars or from an offshore perspective. And ultimately, you then get the best of both worlds. They're global players, but you're buying them at a massive South African discount. So examples of that would be a number of commodity shares, whether that be Anglo Gold, Anglo American, Glencore, Northam. Those are opportunities that we're seeing where they're cheap in South Africa, great opportunities in terms of an overall thesis. Also Anheuser-Busch, once again, South African listed, obviously dual listed, but a global player. And then more close to home would be the likes of AECI and Discovery. AECI, as an example, it's trading on 8 times historical price earnings, 6 times forward price earnings, a high free cash flow yield. It's below book value. And despite this very low rating, we think its opportunity set is significant. To put it in context, some of its global peers are trading 2.5 to 3 times higher in terms of the rating. New management team, great focus in on the profitable areas, and once again, the areas that are actually global. Mining is where they're going to focus. They are a global player in that space, with 40% of their earnings outside the South African Custom Union. That's based on revenue. When you look at actual earnings, it's significantly higher. So a cheap opportunity listed in South Africa, but actually a global player.
So John, as far as I understand the investment process, you won't include a share purely because it's included in an index. Can you explain the reasoning and how you evaluate index constituents in light of this?
So firstly, we look at our process from a globally integrated perspective. So when we're looking at shares, the analysts are generalists, and within that, they look at both local and global shares. And when it comes to investment committee meetings, we actually move from a local share to a global share and back again. So what we find when you look at particularly the largest index constituents in South Africa, a lot of them are actually global players that just happen to be listed in South Africa. And so they should actually be compared to their global peers. So for example, Naspers or Prosus should be compared against global tech, Sasol against global energy, British American Tobacco against global tobacco, Richemont against global luxury goods. And because of Regulation 28, you almost have this hot box effect within South Africa where investors are benchmark cognizant, they can only take some of their money offshore, and so they invest in these large index constituents. And so frequently we actually see them relatively expensive versus their global peers. But that's not always the case. For example, back in 2020, we saw Anheuser-Busch come under significant pressure. The share price came down, and we were able to buy into that at a very, very attractive level. But generally, what we have done is, for example, we've invested in Philip Morris instead of British American Tobacco. We've invested in BP and Shell instead of Sasol. But what's interesting is during the course of 2023, a number of the larger index constituents came under pressure. And so we've been able to have a look at them, take them through our process, and assess whether they actually make the grade and should be included in our buy lists.
John, I think for many South Africans, the prospects in South Africa seem so bleak that the investment philosophy might make sense on paper. But for our viewers, can you provide a proof positive? How do we know that this approach can work?
So if we go back once again, we look in uncrowded areas, we look for out of favor, cheap opportunities, and then we look for an inherent quality that the rest of the market has missed. What that sometimes means is that we can be early, we can identify stuff that continues to be out of favor, So sometimes we get into investments a little bit early, and similarly, as they've rallied, we tend to get out of them, and sometimes that is also proves to be a little bit early. That being said, the longer term track record that we have is phenomenal. If you go back on the PSG Equity Fund, which goes back to 2002, that fund has generated 2% outperformance of its benchmark after fees and is 3% over this period per year ahead of the average fund in that category. So this process that we embark on clearly does deliver outperformance. Yes, it can be a little bit lumpy at times, but we focus and our clients focus on the longer term type of track record. We don't like to really make too much of a fuss about awards, but they are, once again, the proof that you were referring to. Over the last 10 years at the Raging Bulls, we've been nominated as Best Asset Manager 7 of those 10 years. And if we have a look over the last 2 years, last year we were Asset Manager of the Year and received 5 awards for individual funds. This year we were nominated for 12 individual funds. We once again won 5 awards, and we were runner-up in terms of Asset Manager of the Year. So ultimately, the proof is in the pudding. Our approach does generate outperformance for clients.
John, thank you so much for joining us today and for giving us those practical examples. I think they really help to crystallize the investment process.
Thanks very much, Audrey.